Through our latest video on the Avocab Almasi Fixed Income Accumulation Fund, I've received two questions that I find very important in dispensing more information or knowledge about the operation of the fund and fixed income securities in general, having also looked at the Avocab GAO Fixed Income Distribution Fund. And these are the questions. The first question is by Ranjus 143, and the question is asking is, doesn't level 3 risk category imply high return to high risks? This would explain why the potential returns are so generous. This is a question that is based on the simple knowledge, economic knowledge of high returns, high risk, that there is a trade-off between returns and risk, whereby high returns are expected to prevail in a high risk environment, which I agree, but we need also now to understand what level 3 risk categorization means for this type of a fund, that is the Avocab Almasi Fixed Income Accumulation Fund, compared to the risk categorization level 2 for the Avocab GAO Fixed Income Distribution Fund, which is an ordinary fixed income fund. The GAO is a brand name that the owner of the product, that is Avocab Asset Managers, have given that specific product. Almasi is the brand name for the accumulation fund. But the two products, that is the Ngao Fixed Income Fund and the Almasi Fixed Income Fund, they are both fixed income funds, but with different objectives, and one doing slightly higher in terms of its scope compared to the other. The second question is from Dicky John 6330, and Dicky is asking, how are they able to get an over 20% returns, yet no government bond is giving above 18% returns? 83% of their assets have been allocated to government bonds. That is a very good observation. And it is based on the fact that this fund came into operation on 3rd June of 2024. And if you remember, in 2024, we had some of the highest returning bonds in terms of coupons, the IFBs that were giving us in excesses of 17. I think one came at around 18%, 17%, 14%, 15%. And that is the basis of Mr. Ndeki's question, that why is the Avocab Almasi Fixed Income Accumulation Fund able to deliver a return in excess of 20%, while by as a matter of fact, we know that we do not have a government bond that is giving us a return in excess of 18%? That is a very good question. Now, this is what we need to have an understanding about the general or the complete investor experience when it comes to bond investing. And number one is the low entry levels to investment. That in general, you require only 50,000 Kenya shillings as your minimum capital to invest in the bond market. Whether you are going through the primary market, that is the CBK, or you are going through the secondary market. While in the secondary market, it might be tricky for you to get a bond of that size. The second part of the investor complete experience will talk up the top-up amounts. You are able to purchase a bond, additional bonds of at a minimum of 50,000. But now the question of topping up. It will be very difficult for you as an investor to top up such a low amount on an existing bond in the secondary market. The reason being that there is an active bond trading section in the secondary market which trades in excesses of 10 billion worth of bonds on a daily basis. But that market is skewed in favor of large investors, and these are the fund managers. They trade in huge volumes, and therefore, to get a purchase or a sale of such an amount, 50,000, 100,000, or a million, those are trades that are considered odd in that market. And that's one of the challenge that you need to note somewhere. The third is about capital gain, where capital gain only happen through appreciation in value of an asset that you are holding. If you purchase a bond, depending on the market dynamics of demand and supply, the yields of the bonds that you are holding, that bond in the secondary market could be appreciating or increasing in its value. What that means that the increased value can only be accrued as an income to you on condition you sell that instrument. And remember, as the second item on top of for the trade market, we have said it's quite difficult for such odd trades to succeed in the secondary market. Therefore, even when you have increased value of the bond that you are holding in the secondary market, as a retail investor, you have that problem of selling your bond to realize these increased value as a gain. The first gain that you get from bond investing, which is the normal return, the coupons that you are paid half yearly or after every 6 months. The capital gain becomes the challenge because you can only realize that gain on increased value on liquidation, that is sell, which we have identified as a key problem to a retail investor. The fourth issue is on valuation. Retail holders of bonds have no need to keep on valuing their instruments that they are holding, except for those whose portfolios are being managed by professionals for portfolio balancing, where in the cases of horizontal portfolio balancing, where these investor has fixed instruments and equities, and the valuations have to be done for purposes of balancing, then such an investor, without that need of valuation, there is that portion, the valuation gains that do not accrue to a retail investor. And that is the reason why, as a channel, we have insisted for the longest time that as a retail investor, purchase or invest in the bonds that you are willing to hold to term or to their maturity, because the challenges that we have highlighted. The other part will now accrue to challenges to a fund manager who is running a fund of the nature of the Almasi Fixed Income Accumulation Fund, because unlike the GAO Distribution Fund, which is just an ordinary fixed income fund, the Almasi Fixed Income Accumulation Fund is basically a trading platform. The fund manager does not buy bonds just to hold them to term like a retail investor. The fund manager purchases these bonds, holds them for a period, and considering the increased values in the secondary market for the bonds that the fund manager is holding and the valuations, the fund manager disposes these bonds to release or to realize these capital gains, which are distributed to the investors together with any coupons that are paid. The valuations are also done, unlike for the ordinary fixed income fund and holdings by retail investors. These valuations are also distributed to the investors in the fund. And therefore, with that explanation, we can identify the following gains as what accrues to this fund. And out of that, we now look at what accrues to you as a retail investor. A retail investor, the bonds that you are holding, which you have also laddered for purposes of getting monthly returns, the return that you are getting is interest on these bonds, what we call coupons. And the laddering is what is giving you a coupon per month, because holding various bonds that are paying in different months, that would give you, necessitate an income on a monthly basis. That is the coupon. What our friend is asking, the question on why is it that this fund is able to generate a return that is higher than the non-highest coupon of the bonds in 2024 to date. Apart from the coupon sharing, we have the capital gains that are being released through the trading. Those are profits of an increased value of the instruments in the secondary market. Those capital gains are not being earned or are not accruing to a retail investor who is holding that instrument at 18% coupon. So on and above the 18% coupon that has been distributed in the fund, on top of that, there are those capital gains that will also be distributed. And we shall have the periodic valuations of the fund, which are also distributed to the investors in the fund. And that is the key reason why this fund is able to deliver a return that is way above the instrument that you know as highest return in the market, or what retail investors are holding being the highest returning instruments, because the retail investor is not getting the capital gains because of the inability or the problem, the challenge of liquidation in the secondary market. And also the retail investor is not doing valuations of those instruments unless they are doing portfolio balancing. Then the second question on the risk category level 3. The GAO Fixed Income Distribution Fund has a risk category level 2, just like any other fixed income fund. All fixed income funds are in risk category level 2. That category is because of the exposure to fixed income instruments. The normal risks associated to holding fixed income instruments include: 1, delays in payments of the interest or returns by the issuers of the instruments. Sometimes the issuers of the instruments, being borrowers, they can delay in paying the coupons, paying the interest, which is a risk exposure. The other risk exposure in holding a fixed income instrument is total default by the issuers. Those are the parties that borrowed the money. They may completely default in paying those amounts, because the funds or fixed income funds, they not only invest in government bonds and treasury bills, they also go for term deposits or fixed deposits, and also corporate bonds and commercial papers. Rarely do government bonds give problems, but the exposure to corporate bonds poses a risk of default. That is the major risk associated to holding those instruments in an ordinary fund and a retail investor. But when it comes to a fund that is engaging in trading of the instruments, and that is the like of the Avocap Almasi Fixed Income Fund, now there comes in some other risks associated to the trading aspect. Those are risks on above what the risk exposures by mere holding of the instruments to term, as indicated in risk level 2 categorization for an ordinary fixed income fund. When you are trading these instruments, there are charges or costs that the fund manager shall incur in disposing the instruments and acquiring others in the secondary market. On and above that, there are fluctuations in the valuations or prices and yields of these instruments, because the fund also values and distributes the valuation gains. That is another level of risk exposure. Another risk exposure is when there are short notice because of market shocks that would necessitate for the fund manager to dispose of a particular instrument that they are holding. That cannot happen without the fund manager losing or incurring a loss, Because such trades where you are disposing on short notice, there has to be a loss to be incurred, becoming another risk exposure. General loss in yields of the underlying assets, including a review on risk categorization of the issuer of the bond, that will also affect the yields and the values of the underlying asset in the fund, which also exposes the amounts invested under the fund. So those are examples of the extra risks associated with the trading in the type of a fund of the nature of Avocap Almasi fixed income fund. And that is what now makes this fund a risk category level 3 when compared to an ordinary fixed income fund like the Ngao distribution fund, which has a risk level category 2. Those extra exposure to risk, I agree with the question or the observation that the higher risks also come with higher gains, because in the absence of those risk elements that we highlighted, then they will accrue as gains, delivering a higher value in this fund compared to an ordinary fixed income fund or any other fund in the risk level category 1 or 2. I hope that in-depth look into the general or complete investor experience in these type of funds has answered the two questions. Thank you for watching and see you in our next video.